Today, we're diving into what might just be the most overlooked ETF in the entire market, IWR, the iShares Russell Mid-Cap ETF.
You know, in a market that's absolutely obsessed with the giants, the S&P 500, and the crazy potential of small caps, there's this powerful segment that just gets ignored. We're going to find out if this middle ground is where the real opportunity for smart, balanced growth is hiding. Okay, let's get into it.
And just a quick reminder, this is all for educational purposes. It's not financial advice.
So what is IWR, really? Well, it's an ETF from iShares, and it tracks the Russell Mid-Cap Index. You can think of it as the next tier of American business. We're talking about 800 companies that are way too big to be small caps, but they're not quite mega caps yet. They're established for sure, but they've still got plenty of room to run.
And that brings us to the whole reason we're talking about this today, the sweet spot thesis. The whole argument is that IWR can give investors the best of both worlds. You get the stability and profitability you'd find in those big, large-cap companies, but you combine it with the higher growth runway you usually only get from smaller firms. Okay, so does the data actually back that up? Let's decode the key metrics that define IWR and see what the numbers really tell us. All right, first up is diversification, and this is a huge deal. The top 10 companies in IWR only make up 6.1% of the entire fund. Now, to put that in perspective, in a popular S&P 500 ETF, the top 10 can be over a third of the fund. This super low concentration means you're not just betting on the fate of a few mega companies. A bad quarter for one of them isn't going to totally derail your investment. Next up, let's talk income. IWR has a dividend yield of around 1.62%. Now, I know that might not sound like a massive number, but here's what's so interesting. It's actually the highest yield among its direct Russell peers. Yep, higher than both the large cap and the small cap funds. That's a pretty significant and honestly often overlooked income advantage.
So what about valuation? Are you overpaying? Well, with a price-to-earnings ratio of about 18.4, IWR sits in a really reasonable spot. It completely avoids those sometimes frothy, crazy high valuations of the small cap world where PE ratios can just skyrocket past 60, but it's still cheaper than a lot of the big-name mega-cap growth stocks you hear about every single day.
Okay, so the metrics look really solid, but that brings us to the most important question of all, right? How has it actually performed? Let's dig into 20 years of data and see if this sweet spot really delivers the goods.
It's a great theory. It sounds good on paper, but does it actually translate into better returns in your portfolio over the long haul? Does this balance of growth and quality actually lead to outperformance? So let's just quickly frame the argument again. On one side, IWR offers much better quality than small cap indexes, where, believe it or not, up to 40% of the companies can be unprofitable. But on the other side, these mid-cap companies have a way longer runway for growth than some $3 trillion mega-cap company does. And here it is. This chart, this is really the whole story. Over the last 20 years, IWR has delivered an annualized return of about 10.5%. And that's not just a little better. It has actually beaten both its large-cap counterpart, which came in at 10%, and its small-cap peer, which was way down at 8.1%. So the big takeaway here is that the long-term data absolutely backs up the sweet spot thesis. Now, of course, IWR isn't the only game in town. It has a major competitor, the iShares Core S&P Midcap ETF, also known as IJH. We really need to compare them to get the full picture. So let's break down the key trade-offs here, because this is where you, as an investor, really have a choice to make. With IWR, you're getting broader diversification. We're talking over 800 holdings, but look at that expense ratio. Its competitor, IJH, is dramatically cheaper at 0.05% versus IWR's 0.18%. Now, a key difference is that IJH's index has a profitability filter, which means it requires a company to have positive earnings to even be included. It's a quality screen that IWR just doesn't have. So the choice is yours. Do you want more diversification with IWR, or do you want the lower cost and that quality filter from IJH? Of course, no investment is a sure thing. So let's take a balanced look at the potential downsides and the economic conditions where an ETF like IWR tends to shine.
There are really three main risks you got to be aware of. First, we just talked about it. The expense ratio is a disadvantage. Second is something people call the middle child problem. In a market panic, big investors might sell their large caps for safety, and speculative investors might dump their small caps.
Midcaps can get caught right in the middle, and that can create a short-term liquidity crunch. And finally, because these companies are so tied to the domestic economy, they can be a bit more sensitive to recessions.
But on the flip side, IWR is structurally set up to do really well when interest rates are falling. Think of it this way. When it's cheaper for companies to borrow money, it's just easier for these established, growing businesses to expand. And lower rates also tend to make investors willing to pay more for future growth, which pushes up valuations. So yeah, a period of falling rates can be a very, very good thing for midcaps.
So, after looking at the numbers, the performance, the competition, and the risks, what's the final verdict on IWR?
Well, IWR seems best suited for a few specific kinds of investors. First, long-term investors who are really looking for a core holding that perfectly balances growth and quality. Second, portfolio builders who want true diversification away from the handful of megacaps that dominate the S&P 500. And finally, anyone who specifically wants to build their portfolio using the consistent family of Russell indexes.
And that really leaves us with this final thought. When you look at its unique combination of diversification, yield, reasonable valuation, and its proven long-term outperformance, IWR might just be the most balanced equity ETF you can own, and yet almost no one is talking about it.
As always, please remember to consult with a financial professional before making any investment decisions. Thanks for joining me.